I invest with debt. If I pick the wrong fund, I don't just lose money, I get liquidated. If I use margin on typical high yield funds like YieldMax, I would be broke. But there's one specific type of fund that defies the odds. Sure, the yield on some funds looks astronomical, but if you look at the share price, it crashes almost as much as it paid out. You aren't making money, you are just getting paid your own principal back. My fund pays a boring 12%, but the share price goes up. I will take the 12% that builds my account over the 50% that destroys it. The internet calls them all yield traps. Today I'm going to prove why the internet is lazy and break down the specific math behind the only high yield assets I trust with my life savings. I was going to give you a cute analogy about trees and barrels, but you don't need that. You just need to look at the charts. This is the only chart that matters for a margin investor. The blue line is a typical high yield synthetic fund like ULTY. The orange line is a physical fund like SPYI. The blue line screams 50% yield at you. That sounds amazing. But look at the direction of the line. It is a landslide. To pay you that yield, the fund is effectively liquidating its own assets. Now look at the orange line. It pays a boring 12%. But notice something? It didn't crash. It actually went up. It paid the distribution from profit, not principal. Here is why this is life or death for my channel. M1 Finance determines my borrowing power based on the share price, the line, not the dividend. If I held the blue line, my collateral would be shrinking every single day. My risk of a margin call would skyrocket, even if I was getting paid cash. With the orange line, my collateral is stable. I am willing to trade a lower yield for a chart that doesn't look like a crime scene. Price stability is my protection. Now let's be fair. If you buy YieldMax funds with cash, you usually make money. Their total return is positive because the dividends are so massive they offset the price drop. But I'm not a cash investor, I'm a margin investor. And for me, total return is a dangerous metric. Here's the math problem. If a fund pays me $1,000 in cash, but the share price drops by $500, sure, my wallet got fatter, but my shield got smaller. My safety buffer is physical share price. When that price drops, the wall holding back the margin call gets weaker. M1 Finance calculates my margin limit based on my share price, not the cash in my checking account. If the NAV erodes, my leverage ratio rises automatically. That is a recipe for disaster. I can't post cash as collateral for a margin loan after I spend it. I need the asset itself to hold its ground. That is why I choose SPYI and QQQI. I would rather take a lower 12% yield with a stable price than a 50% yield that slowly eats my borrowing power. Now let's look at the chart. Since inception, QQQI hasn't eroded, it has appreciated. This means my collateral is growing. My LTV is naturally going down over time because the denominator is getting bigger. This is the holy grail for margin. Capital preservation plus cash flow. You aren't cannibalizing your borrowing power to pay the interest. There's one more advantage NEOS has over holding individual covered calls. They use Section 1256 index options. That means 60% of the income is taxed at a lower long-term capital gains rate. So it's efficient tax-wise, it grows in price, and it pays 12%. That is why it's the engine of my portfolio. Stop comparing these good funds to yield traps. They are growth funds with a turbocharger. And as always, please remember, I am not a financial advisor. This is just for entertainment. Margin is risky, so always do your own research. I'll see you in the next update.